Welcome to part 4 of my Technical Analysis Foundation course, Trend Analysis. This lesson is brought to you guys by Femex. I'll talk more about them later in this video. Let's go over the content for this lesson. First, I'm going to talk a little bit more about demand and supply, reinforce some of the concepts we discussed last time. Then we're going to go into what a trend actually is. I'm going to tell you how you can use a trend in your analysis. Then we're going to talk about trends within trends and how we can have multiple different trends at the same time. So I'm going to go over the usual disclaimers. This video is for entertainment purposes only. Any information spoken or written should not be interpreted as financial advice. Carry out your own independent verification of facts and data. Don't just take my word for anything. I am not a financial advisor. I do not hold any relevant qualifications. If you seek financial advice, speak to a professional. And finally, trading is an extremely risky activity. Your trades are your responsibility, so trade at your own risk. A shift in demand and supply. Now, if you guys remember from last week's lesson, which if you haven't seen, I really recommend you go watch. It'll be linked somewhere in the description below. Remember, we have the law of supply and the law of demand. One represents the sellers, the other represents the buyers. As the price moves, it's constantly trying to find this equilibrium point. When it goes above this equilibrium, well, there's a surplus of supply, so sellers bring the price down. When it goes below, well, there's a surplus of demand. Lots of people want to buy, not that many people want to sell, so the price goes up. And although we touched on the topic, what we didn't discuss last week in great detail is that the supply and demand curves themselves are also always moving alongside the price. In this example here, you can see the demand curve moves over and the equilibrium price moves slightly higher. And in this example, you can see that supply is decreasing. It's moving back, so there's less sellers. Because there are less sellers, well, there's not going to be surplus supply anymore at this price. Instead, the equilibrium point moves here. Also, the lines aren't always straight. They can be curved, and in reality, they often are. They're never really going to be a perfect straight line with a perfect ratio for every price move that goes up or down. So now imagine a scenario, for example, where the demand is constantly shifting in this direction. So the equilibrium price is moving higher and higher. So the price of the asset you're trading keeps bouncing around at higher and higher points. When this happens, we create a trend. Now, what is a trend? Well, we have 3 different types of trends. First, there's an uptrend. An uptrend involves consecutive higher highs and higher lows. A downtrend involves consecutive lower highs and lower lows. No trend is when the market moves sideways. The price isn't really moving up, it's not really moving down. It's bound in a range, and the levels of these ranges can change. So here's an example of an uptrend. We can start down here, and you can see the price goes up, and here it forms a high. It comes down and forms a low here. The next time the price moves up, pay attention, goes up to here and it makes a new high. If you compare this high to this high down here, this high is higher than this one. And I know it seems like common sense, but that's why we call it a higher high. Here we have a higher low because it's higher than this low. We continue this all the way up to here. Higher high, higher low, higher high, higher low, and so on until the top over here. This is clearly an uptrend because we keep making new highs and we don't break old lows. We take a look at this second example. This is our same uptrend, but once the price reached the peak over here, we had a reversal. And what happened next? The price made a low here, which is lower than this low there, hence a lower low. Here, we have a lower high because it's lower than this high there. But remember, discretion is extremely important when performing analysis. This move here, in the context of this big move there, isn't that significant. So I paid more attention to the low formed here because of the magnitude of the move and how it seemed a lot more important in context. Lower low, lower high, lower low, lower high, and so on. The trend continues. Next, let's look at a situation where there is no trend. So we can see a lower low made over here. Then we have technically a higher low over here, higher high over there, higher low here, lower high there. There's no real pattern to this. The price is just bouncing between these two key levels with slight deviations here, here, and here. And this is a ranging market. It's not moving in any clear direction. It's generally moving sideways, and often you'll find no trends bound between a support and resistance level. So in the next part of our lesson, and this is going to be very important, we're going to talk about how to use trends as Confluence, how to actually use them in our trading. I really want to make more free courses for you, but these take an immense amount of time and energy. To support me and get yourselves more free courses, all you have to do is use my link and make an account on Phoenix. That's all I'll say on it. Let's get right back into the video. During an uptrend, there's a higher probability of supports holding. There's a higher probability of resistance breaking. And there's a higher probability of broken resistance turning into support. Why is this? Momentum builds. When demand is overwhelming the sellers are also going to panic. It's like a domino effect. As one gets stronger, the other gets weaker. They can even flip sides, including people who are flat coming in and joining the uptrend. Momentum builds, and it's something to pay attention to. Remember our visualization example when I talked about the two armies battling it out. During an uptrend, the bull armies have the higher ground. The bull armies will be at an advantage during every interaction they have with the bears. During a downtrend, we have the exact opposite. You see, a lot of technical analysis is common sense. As long as you understand the basic principles, all of it's intuitive. And that is one of the biggest goals I have with this course, to give you an intuitive understanding. So all you need is the basics, and advanced stuff almost become clear on their own. So here is the same example we had before, and you guys can see Confluence in action. So we have a strong resistance up here. Remember the range I showed you earlier where there was no trend? That area was this area down here. And this is the resistance from that. The resistance breaks. This candle here closes above. Remember, a broken resistance. What does a broken resistance do? It flips into a support. So this resistance breaks. Price goes up, comes back down, and this support holds. So now we have two new resistances from the price action. Look, price goes up. We hit a wall over here. And there was a wall hit over here as well. So we break past this wall over here, and we break past this wall over here as well. What happens? Price goes up, hits a new wall up there, comes back down, and what has this broken resistance done? It's become a support. Look at how it holds the price up over here. But it did break, and what happened to this? Remember, this was our resistance over here, and now it's a support. This has become a resistance again. Breaks back down, becomes a support, and we go up here. So again, new wall formed over here. Why? It's obvious. Look, the price is being pushed back down. Clearly, the bears are resisting this level. And this broken resistance here, what's it done? It's become a support. Yes, this one isn't as perfect as these ones, but still, it's the same general area holding up. Price goes back up, breaks this level, and look at this tiny wick over here. This has become a support. Price goes up, comes back down. Where does it bounce? Surprise, surprise, the broken resistance. Price goes back up, back down. This level holds again. But now what's happened? Guys, pay attention to what's happened here. Remember context with support and resistance. Price bounces, goes up to there, comes back down. Price bounces again, nowhere near as high as before. Comes back down, a couple weak bounces, and it breaks. Now, remember this level here? That was first the resistance, then became a support. Now it's breaking again. We come back down, and look at this level here. It was a resistance there, broke, became a support, broke again here, and now it's acting as a support. Goes back up, and this previous level here, resistance. Do you see how these flip back and forth? And remember the trend. Now we have the trend as our friend. We can see how these levels, the levels which break and the levels which hold, start to change. That's the beauty of a trend. You know what's probable. We know that this level, now that price has gone back up and it's formed a lower high, it's more likely to break this support. Price comes down and it hits this support over here. You can find this across every asset. And this is the type of thing I want you guys to be doing when I give you homework and I tell you to go practice. Drawing these lines, trying to find these patterns, scrolling through the charts. This is experience. The more you see of this, the more likely you are to come up with hypotheses to form your own systems. Next, final example, no trend. Well, no trends are harder to trade. Not harder necessarily, depends on your trading style, but they're different. There's no real increase or decrease in probability of support and resistance holding, and generally, I find there's a reduced probability of most arguments holding within that range, because once the price bounces up and down for a long enough period of time during that range or area of consolidation, people become less emotionally attached to it. So buyers and sellers care less whether or not a level breaks. Hopefully that makes sense. Now, the final part of this lesson, trends within trends. It's not as if there's either an uptrend or a downtrend or no trend. There's actually multiple layers to this. And it's all about time frame. You guys know by now that we have higher time frames and we have lower time frames. Well, there can be a different trend within each of these time frames. So we can have a downtrend within an uptrend, within a downtrend, within no trend, within an uptrend, and that can continue on indefinitely. It depends which time frame you're looking at. As traders, we generally tend to isolate. So there'll be too much noise if we try to analyze every single time frame. As you'll learn in the next lessons, what traders do is they tend to pick 2 or 3 time frames and only look at those. Remember, lower time frames, arguments use less data and they're more volatile. Trends don't last as long. Higher time frames. Trends are formed from the lower time frame trends, so multiple lower time frame trends form a higher time frame trend. These trends are less volatile and last longer. Why? It's high time frame data. It's more reliable, it's less volatile. Every time I ask you the difference between low time frame data and higher time frame data, your answer can be almost exactly the same. Higher time frame is less volatile, more significant. Lower time frame is more volatile, less significant. That's it. It's very simple. I've said it multiple times, but I'm going to keep saying it. If you understand the core concepts, everything else becomes intuition. You can figure out advanced stuff just by understanding the basics well. And that is the aim of this course, to really drill in the basics. Next, high and low are relative. What do I mean by this? When I say higher time frame or lower time frame, I'm giving you general time frames you can play around with, but it depends on what you're trading. If you're looking for entries on the 15-minute chart, then the 1-hour chart is going to be a higher time frame for you. The 1 hour could be your high time frame, and then the 15-minute could be your low time frame chart. If you're trading the 12-hour, well, suddenly the 1-hour chart is seen as lower time frame. Keep it simple. If you're just starting out, pick one higher time frame you like to play around with and one lower time frame you like to play around with. Personally, I love using the 1 hour and the 15-minute. I'm an aggressive day trader, so I could definitely recommend the 1 hour and the 15-minute. If you want to play around with high time frame charts, try the 12-hour and the 1 hour, or you can try the 1 day and the 4 hour, whatever you want. Pick and choose your combinations, as long as they are at least less than half the size of each other. So for example, I wouldn't take the 12-hour and the 6-hour because you're looking at very similar data. So make sure it's at least less than half the size of the time frame you're playing with. Last point, people will swear by using an indicator on a certain time frame, or always looking for trends on the 1 day or the 3 day or the 4.5 day. There is no magic time frame. The only thing which determines whether or not your strategy is good is if it makes money in the market. If you test the strategy on the 1 day and it does well, chances are if you test it on the 1.1 or the 0.9 day, it's going to work absolutely fine as well. It's only going to be minute differences, and that'll be largely luck. So if that doesn't make sense, don't worry about it. It's not too important. The key point is no magic timeframes. You can use whatever you want, whatever you're comfortable with. Now, this is one of our shortest lessons. I really wanted the idea of a trend to sink in, and the homework is less than the previous weeks, but quite important, and I'll explain exactly why in a sec. First things first, take notes, guys. Anything that you really liked, anything that made sense to you, write it down or you will forget it. Make some notes on this lesson. Next, guys, start to gain experience. Simple task, spot a trend on a chart, and then make a note of what the trend is. Try to watch uptrends transition into no trends, transitioning into downtrends, or whatever the transitions are, try and spot them, look at them, different assets. You don't just have to look at one. And then if you're feeling more ambitious, you can, once you've identified the trend, do the same exercises as before, where you introduce support resistance levels, use your bull bear meter to paint candlestick pictures and try spot patterns on top of the trend. Make a note of how they behave differently depending on the trend. All of this is extremely important because it develops experience without you having to be in the markets risking your money.